If you checked your portfolio last week and did a double take at silver prices, you were not alone. Silver briefly touched $96 per ounce on March 2nd, 2026, a move that sent shockwaves through commodity markets globally. That is a metal which was sitting around $28 just 14 months ago. So what on earth is happening? And more importantly, what does an observer need to understand about this market right now? Let us break it all down. The fear, the fundamentals, and the frameworks that explain silver's extraordinary behavior. Let us start with what actually happened last week. On the night of March the 2nd, reports emerged of U.S. and Israeli military strikes on Iranian nuclear sites, followed by Iran's reported move to deploy sea mines near the Strait of Hormuz. That single phrase, Strait of Hormuz, is enough to send commodity markets into overdrive. Nearly 20% of the world's oil passes through that channel. The moment traders heard blockade, the flight to safety began. Gold surged past $5,400 per ounce. Silver exploded, briefly crossing $96.40, before crashing nearly 7% intraday and stabilizing around $88 to $93. That violent up and down move in a single session tells you something critical about silver. It is not gold. It behaves differently. And understanding why is the entire point of today's discussion. Silver sits at a fascinating and complicated crossroads in the world of assets. On one side, it behaves like a precious metal, a store of value, a safe haven that investors flee toward in times of geopolitical turmoil, currency uncertainty, or inflationary fear. On the other side, it is an industrial workhorse. More than half of global silver demand today comes from industrial applications: solar panels, electric vehicles, semiconductors, AI data centers, and advanced electronics. This dual identity is precisely why silver's price action is so explosive and so difficult to interpret cleanly. When bombs fly, as one market analyst colorfully put it, investors dump stocks and buy gold. Silver follows gold, riding the safe haven wave. But here is where silver gets complicated. The same geopolitical events that trigger safe haven buying also raise recession fears. If oil supply is disrupted, if energy prices spike, if global trade slows, industrial demand for silver suffers. That recession anxiety was exactly what caused silver's sharp 7% intraday reversal last week. The market was simultaneously pricing in T-to-2O contradictory outcomes. That tug of war is not a bug in silver's behavior. It is a feature. It explains why silver is historically more volatile than gold and why it tends to overshoot in both directions. Now let us zoom out and look at the structural story behind these geopolitical fireworks, because the Middle East tensions are accelerating something that was already well underway. According to the Silver Institute, 2025 marked the 5th consecutive year of a global silver supply deficit. Demand exceeded mine production, and recycling by roughly 160 to 200 million ounces. That is not a temporary blip. It is a structural imbalance that has been building for years. Silver jumped from $28.92 at the start of 2025 to over $72 by year end, a gain of 147%, before the current geopolitical crisis pushed prices toward the 90s. What is driving that industrial demand? 3 major trends: solar energy, electric vehicles, and artificial intelligence infrastructure. Solar panel manufacturing now accounts for a significant and growing share of annual silver consumption, and analysts project this. Demand will only accelerate through the 2030s. Every new solar gigafactory, every EV battery management system, every AI data center chip, they all consume silver. Meanwhile, mining output is growing slowly, new large-scale silver deposits are rare, and the lag time between a mining discovery and actual production is often a decade. This supply-demand gap is not going away soon. So what does this mean for someone observing the market? JP Morgan's commodity analysts project silver averaging around $81 per ounce in 2026, with peaks potentially hitting $85 in Q4. More bullish voices, including analysts at Gold Silver, have suggested triple-digit silver is increasingly plausible. The gold-silver ratio, which historically fluctuates between 51 and 80.1, has been a key tool analysts use to evaluate silver's relative valuation versus gold. If gold remains elevated and the ratio compresses toward historical norms, the mathematical implication for silver's price is significant. But all of these are observations about market dynamics, not guarantees. This brings us to how observers, students of markets, and long-term thinkers have historically approached assets like silver. One pattern worth noting is the role of systematic investment plans, or SIPs. Rather than trying to time a volatile, geopolitics-driven commodity, some investors historically have used SIPs to build exposure gradually, spreading purchases over months or years to average out the wild swings. In India, silver ETFs, like Nippon India Silver ETF, KC Prudential Silver ETF, and HDFC Silver ETF have seen explosive growth in assets under management in 2026. Nippon India Silver ETF alone manages approximately R28,944 crore. These funds allow exposure to silver prices without the headaches of physical storage, starting with SIPs as low as 100. Globally, iShares Silver Trust, the world's largest silver ETF with over $56 billion in assets, has seen one-month returns of roughly 60% during the current rally. But here's the crucial thing: any informed observer must hold in their head simultaneously. What goes up 20% in a week based on geopolitical fear can come down just as sharply. If diplomatic negotiations succeed, if Strait of Hormuz reopens, if Trump's 4 to 5 week conflict timeline plays out, markets can reprice silver downward very quickly. The structural bull case, rooted in supply deficits and industrial demand, remains intact regardless of geopolitics. But the timing of that thesis playing out is something no one has a clean answer to. Silver's volatility is not just a risk to manage. It is the very characteristic that creates both the narrative excitement and the investment complexity. The metal's smaller market size relative to gold means that demand surges produce amplified percentage moves. The same dynamic cuts both ways. In the 2020 disruption, silver surged 47% in months. In previous cycles, it corrected just as sharply. Understanding that pattern, not as a predictor, but as a historical observation, is what separates informed market watchers from those who simply react to headlines. The headline asks, "Buy now?" That is precisely the wrong question to take to a volatile, geopolitics-driven commodity market. The more interesting question, the one worth sitting with, is this: what is silver's role in the world over the next decade, given the energy transition, AI infrastructure demand, and ongoing currency uncertainty? The data today suggests a metal under structural pressure from the demand side. The geopolitical events of last week simply put a spotlight on something that was already unfolding quietly beneath the surface. Whether you are a market student, a financial educator, or simply someone trying to understand why your newsfeed is suddenly full of silver charts, that structural story is the one that deserves your attention. The fireworks from the Middle East are dramatic, but the slow-burning fuse of industrial demand was already lit long before the bombs started flying. This script is for educational and observational purposes only. It does not constitute financial advice. Always consult a qualified financial professional before making any investment decisions.